Welcome back, everybody. Today we're going to do a quick analysis of Caterpillar. Caterpillar, of course, is a massive, yeah, they make machinery. Definitely a high quality company for sure. Massive moat. Well, not massive moat because there are other manufacturers like in China and stuff, but yeah, it's not easy to get into the machinery manufacturing business, especially on a scale that Caterpillar doesn't. They are a $183 billion company, and on the 5-year chart, they are up 160%. You would have outperformed the S&P 500 if you bought it 5 years ago. That is for sure. So they're now trading at an 18 price to earnings ratio, which actually isn't too bad, but I don't really think that they can sustain this, and we'll see why. So. They also pay a small dividend. Let's take a closer look into their financials. In terms of their revenue, it has grown pretty steadily. Well, except for 2019, it declined. 2020, it declined. And then 2021, you're not even back up to where you were in 2018. But then after that, they grew pretty substantially in 2022 and 2023, probably due to extra construction spending. At least that's what I would guess. Although the cost of their goods sold hasn't really increased as much as their revenue, which really expanded their gross profit. So either that's cost cutting or something else. And now we're looking at, so they had a record income last year, and I don't know if if that's because they cut a lot of cost last year or not, but yeah, they had record income, and I let's they also buy back stock. Let's look at their balance sheet. They have a okay balance sheet. Their net debt is 31 billion, but their income was what, like 10 billion. So it's not horrible. They could pay it off in 3 years. Cash flow. In terms of cash flow, they buy back a bunch of stock, or they bought back a bunch of stock last year. Um, Not quite sure if that was the smartest thing to do to buy back stock at all-time highs. Uh, well, not well, close to all-time highs. It would be interesting to see how much stock they buy back in Q1 of 2024. Also, they pay a dividend as well, 2.56 billion in dividends. It comes out to what, like 1.6%, we said. In terms of stats, let's check out their margins. Their ROIC actually has been really high in the last couple years, and their gross margin at 28% has jumped up to 35%, and then we've got the net margin has hovered right around 12% for the most part, 11 to 12%, and then the last year it was 15. Okay, this is something that I found for Caterpillar. Okay, let's zoom this in really quick here so that you guys can all see. They reported revenues of 3.25 billion for 2023, an increase of 514 million or 19%. Okay. The increase in revenues was primarily due to 450 million favorable impact from higher average financing rates. So 450 million of the 514 million was because of financing rates. So I'm guessing that has to do with um, the interest rates right now and how they're higher. So they must loan out their equipment. Like they basically act as a bank. They loan out their equipment and then they collect money from higher interest rates. So I'm guessing that's why their profit was so much higher. Yeah, profit was 563 million compared with 535 million, which is only a 5% increase. I thought it was way higher than that, but yeah. So that was really interesting to see. And so seeing that raises an alarm bell, meaning that um, if interest rates drop, then this company's margins are going to get squeezed again. And also, um, we've had a couple of years where there's been a massive amounts of construction spending, and if that doesn't continue, then they definitely won't continue to grow, and they will probably decline in revenue and earnings. Let's take a look at the statistics on the new Yahoo Finance page. So they actually updated this. It looks different now. But what I like to look at is short percentage, and their short percentage right now is 2.6%, which is actually quite high for such a high quality company. Like I would not expect that. If we look at Apple, Apple is like 0.5%, like basically nothing. But yeah, short percentage of 2.6% is actually sort of concerning. Like at least it's not like really high at like 10 or 5, but still 2.6% for such a high quality business is kind of interesting to me. Um, we can also look at the analysis and see what the analysts are projecting, because this is what I like to use in my DCF model. So we have an average estimate of 21.31 earnings per share going up to 22, and then 67 billion going up to 69 billion, or a 3% increase. So I plugged that stuff into my DCF model. Even though I think the analysts might be a little bit wrong on their views, because I don't know if they're looking at that um, interest on revenue that I just showed you guys or not. But yeah. Okay, I put the EPS revenue there, buybacks, net debt, whatever, discount rate 10% because I want the 10% return on all my stocks. Exit multiple of 20. I think that's completely fair for this business because they are such a high quality business. They have a moat. And yeah, 20 is for sure fair for this. In terms of earnings, I put 5% growth for next year. That's kind of what the analysts were projecting, and then falling off to 2%, just basically keeping up with inflation. Otherwise, this could easily be negative. This could easily be like negative 10. This could easily be negative 10, and then growing back up from there. So, yeah, I think that this is probably pretty. I don't know. I don't know. I don't want to say it's optimistic, but even with this earnings growth, we're still not at a fair share price. Um, at least if you want the 10% return. And then with the revenue and margins, they did 15% last year. I don't know if they can keep that up, especially if they go back to their historical average of 12%. I think that would probably be a more likely scenario. And then also growth, probably their growth just keeps up with inflation because they are such a large company already. And also, construction spending could easily decline in the coming years. So with that, the fair share price being 334. If the profit margin decided to drop, maybe the profit margin decides to drop down to 12%, then we're looking at a fair share price of $250 a share. Yeah, this is a business that is very, very expensive right now, uh, probably because of their record high earnings and record high revenue, but I don't actually think that that's going to continue into the future. And that is the conclusion of the stock. Definitely, I'm staying away. I don't know what you guys want to do. If you guys think that their growth is going to continue, then you can actually plug your own numbers into the spreadsheet. Just download it. There's a link in the description completely for free for you to use. Otherwise, yeah, hit that like button, leave any comments in the comments section, and I'll see you in the next video.